Let me start by thanking our distinguished panelists for their willingness to share with us their knowledge and experience on the subject matter to be discussed today during the webinar. We have received more than 500 requests to attend the webinar, and I welcome the attendees from around 34 jurisdictions that are with us today. The IOSCO World Investor Week started in 2017, and in this context, we are pleased to celebrate this year its 6th annual edition. The World Investor Week campaign has two main objectives. One, disseminate key messages on investor education, investor protection, and financial literacy. And two, foster learning opportunities for investors. In this vein, the IOSCO Asia Pacific Hub is hosting this webinar on crypto, digital assets, and DeFi, Look Before You Leap, with the support of the IOSCO Fintech Task Force. Financial technologies are here to stay, and we need to understand the potential opportunities and the risks they bring with them. Although there are potential benefits from crypto, digital assets, and DeFi, such as the potential to facilitate capital formation, improve or enhance the access to financial products and services, or reduce costs and fees, there are also different risks that actual and potential investors need to be aware of, risks that they need to understand in order to take informed decisions. The so-called crypto asset winter of this year is a clear example of the risks and losses that investors can face in this market. Risks are part of the normal operation of the financial system, but taking risks in a regulated environment is very different from taking risk in a non-regulated market. That is to say, in an environment that lacks the proper regulation, oversight, and enforcement mechanisms that are put in place to protect investors and support the sound operation of the markets. IOSCO members have raised concerns about crypto assets in areas ranging from trading, custody, clearing and settlement, accounting, valuation, and intermediation. Investor education and investor protection have also been part of this discussion within IOSCO. Given the increasing relevance of this matter, one of the recent decisions taken by the IOSCO board was to set up a board-level fintech task force in March of this year. There are many challenges to be addressed. IOSCO and other standard-setting bodies and international financial institutions are working in this area. Although the crypto asset market is global, there are multiple and potentially divergent national regulatory approaches to crypto assets. There is also a lack of a standard taxonomy and terminology. These challenges are compounded by the risks exacerbated by the global pandemic, such as frauds and scams, as well as other developments, such as the emergence of finfluencers. In short, DeFi and crypto assets represent a complex ecosystem. To help us understand the subject matter, I am pleased to introduce our distinguished panelists. We have with us Tuan-Li Lim, who is the chair of the IOSCO Fintech Task Force. He's also the Assistant Managing Director, Capital Markets at the Monetary Authority of Singapore. We also have with us Richard Fox, the lead for the IOSCO Crypto and Digital Assets Working Group. He is also Director International at the Financial Conduct Authority in the UK. And we also have with us Jose Vasco, who is the World Investor Week Working Group Coordinator. He's also a member of the Fintech Task Force and Director of the Office of Investor Protection in the Securities Commission of Brazil. With that, let's kick off the discussion with Tuan-Li. As a quick 101, could you tell us what crypto assets DeFi are, how people typically invest in them, what are the major risks they face when doing so? Over to you, Tuan-Li.
Thank you, Josephat. I'm very grateful for this opportunity to be part of this webinar during the World Investor Week. So to your question, I suspect most of the audience would have a sense of what crypto or DeFi is. But so that we are on the same page, let me touch on a bit on the terminology. So a digital asset is anything of value whose ownership is represented in a digital or computerized form. So this is done through a process by what we call tokenization, which uses a software or program to convert ownership rights over the asset into a digital token. So digital assets are typically used or deployed on distributed ledgers that record the ownership and transfer of ownership on these assets. So tokenized assets generally are what we call forms of financial assets, like can be in the form of cash, bonds, even artwork, or even intangible items like computing resources. So using tokenization, the ownership of these rights of these assets can be converted into what we call digital tokens. So the economic value of such tokenized assets would actually be no different from the original underlying assets. So this is what we call tokenized assets. So cryptocurrencies are actually assets which are either issued directly by a distributed ledger protocol or that operate within a network within the protocol. So these are the common terms that we have heard, cryptocurrencies, and they're usually used as a medium of exchange or a store of value within the network or within the protocol. For example, to pay for transaction fees or to incentivize users to keep the network secure. So, however, cryptocurrencies have taken a life of its own. These assets have, outside the distributed ledger, they have been associated with a lot of speculative activity that has resulted in prices that have very little or nothing to do with any underlying economic value related to the use of the distributed ledger. So when we talk about cryptocurrencies or crypto assets, we refer to this category. Right. As another category that we talk about, we can associate with, which are what we call stable coins, where the token is actually pegged to another asset, usually a fiat currency, such as the US dollar, or they have some actual reserve assets to back the peg. But many actually do not have such a reserve asset. So the very common thing among stable coins is that they hope to be able to have a stable value that can be used as payment instruments on distributed ledgers. So you mentioned DeFi or decentralized finance. It actually tries to replicate financial services by bypassing traditional financial intermediation and centralized institutions. So these services could include trading, lending, borrowing, insurance, among others. So crypto assets or cryptocurrencies and DeFi are intricately linked, as they circulate within the DeFi ecosystem that facilitate exchange of value, and especially cryptocurrencies and stablecoins are the predominant assets in circulation within the DeFi ecosystem. So how do people invest? They actually invest through a service provider, what we call as crypto exchanges. So you give up your fiat currency to exchange for what we call a cryptocurrency or digital asset. So there are many risks associated with cryptocurrencies. So I'll just touch on three. First will be the extreme volatility in prices. Second will be information asymmetry and potential fraud. And third will be actually the physical loss of your cryptocurrency itself, right? So volatile prices, as we know, prices of cryptocurrencies are very volatile, and they fluctuate widely, simply because they do not have actually a fundamental economic value, which makes valuing them very difficult. So at most extreme, prices could crash to zero or near zero, no matter how reputable they are. So we've heard of a recent case of Terra US dollar and the Luna, that token that came to mind. And the second risk is information asymmetry and fraud. Many say that there's actually complete transparency in crypto and DeFi because the code can be viewed by anyone. In theory, this is true, but how many of the investors actually possess the technical skills to read the code? I think not many, right? So in addition, when many invest in some of these projects via tokens, they may not be fully be able to fully understand the mechanics behind the project. And some of these may be set up to benefit the founders of the project at the expense of investors. So the extreme end of it, you have things like rug pulls, pump and dump schemes. So you mentioned the use of influencers and celebrities. So as some of us may be aware, last week a certain US celebrity was settled with the SEC for more than $1 million for her role in promoting a certain token on her social media platform without actually disclosing that she was paid to do so. So many believe that this was a case of a pump and dump scheme where the creators hire celebrities to promote their own coins to inflate prices, and then they sold off their own stakes. So the third risk that I will talk about is loss of your cryptocurrency or your token itself. So sometimes your service provider may actually help you to provide a wallet or a custody service, but sometimes these assets are commingled with their own. And if the service provider goes bankrupt, it's very hard to determine which token belongs to you, or if they didn't properly segregate. At a more technical level, some of the wallets that they provide for customers may actually be hacked into and be stolen. The coins be stolen. For example, there was a case of KuCoin in 2020, where hackers obtained the private keys to the exchange's hot wallets and transferred close to 300 million in cryptocurrencies. So, three risks to watch out for: extreme volatile prices, information asymmetry and fraud, potentially, and of course, you can potentially lose your cryptocurrency or your token. Thank you. Josephat, back to you.
Thank you very much. I mean, it's difficult to see how investors could be protected in this uncertain environment with the risks that you have identified. However, considering that investors have access to these products and services, I wanted to ask Jose Vasco, before an investor considers an investment into crypto assets or DeFi, what are some of the key areas which they should conduct further research in, or what are the potential red flags to look out for? Over to you, Vasco.
Thank you, Josephat, for the question. And I just say it is a great pleasure to be here today on this important webinar on crypto digital assets and DeFi, which is a very important area for World Investor Week, this global investor campaign that is promoted by IOSCO since 2017, as Josephat has just mentioned, and which is a campaign to disseminate key messages for investor protection on themes that are important for IOSCO. And definitely, this is one of the most important themes of our times for supervisors and financial regulators. And perhaps as a lot of efforts has been put on developing, disseminating key messages, perhaps I should start by saying a few words about the key messages of this campaign that are to be disseminated across the globe over this week. For 2000, of course, one of the main themes for 2022 is investor resilience. But also we developed some key messages for crypto assets and for investors. And the campaign recommends that investors understand the risks that are associated with crypto assets. They should not forget about the importance of due diligence when considering any investment opportunity in digital and crypto assets. Also, perhaps never invest based solely on a celebrity endorsement, as just was mentioned here in the case of the United States. And it's really important to recognize the warning signs of investment fraud, which is still rampant in some markets. And for investment fraud, there are some basic attitudes that help investors to avoid being victims of scams and Ponzi schemes or financial pyramids. It's important that he verifies if the investment professional is licensed. He can check his reputation in any case of professional misconduct, as usually these cases are made public by the financial regulators and supervisors in each jurisdictions. The rules are different, but usually when there is any misconduct case, this tends to be public information once there is any fraud proved. It's also key to research investment opportunities before investing, and to be suspicious of any request to wire money out of the country, because these kind of frauds are sometimes global, and never disclosures personal information on an unexpected call or other type of communications, and ensure, because we are talking about the digital world, to have strong passwords and good data security practices, such as two-factor authentication on accounts containing financial data. I just want to complement those signs by perhaps preferring some very important investor alerts that have been published by different regulators like US SEC, CFTC, and UK FCA. And I think there's some warning signs of investment fraud that investors need to look on. One is the guarantee high investment returns. We know that all investments have risks. Investors should question any so-called guarantee return. Please be aware of anyone who promises that you will receive a high rate of return on investment, especially with little or no risks. And claims such as risk-free, zero risk, absolutely safe, and guaranteed profits are really very important signs of fraud. Something also that I think is important to mention is some skyrocketing account values. There are some fake investment accounts that seems to be rapidly increasing in value in providing large returns for investors, and this is usually tactics that fraudsters use to entice investors with the prospects of a great wealth. And if there is a lot of complicated jargon and language that is difficult to understand, this could also be a tactic from the fraudsters. They might sometimes claim their technology is highly secret, and if it's hard to understand, perhaps this is not an investment for you. The fact that some offers are not unsolicited, these may perhaps raise the issue of being extreme caution if you receive any kind of this communication you didn't ask for, and you don't know the sender about an investment opportunities. They may use fake names, misleading photos, and phone numbers that may actually be operational only abroad. And be aware of any pressure to buy right now. There is always an effort to create a sense of urgency to getting on the investment. So it's important to take your time to research an investment opportunity before handing over your money. And one of the key messages of the World Investor Week is actually that investors never feel rushed and should not ignore those signs and take into account these pressures to invest right on the spot, and also the fake testimonials. Never rely solely on testimonials in making an investment decision. Fraudsters sometimes pay people, actors, for example, social media influencers, and even celebrities to promote their investment opportunities. And they sometimes may also be victims because they might not know that this is fraud involved. So I think these are some of the important tips for investors to pay attention to when making a decision on crypto assets and DeFi investments.
Thank you very much, Vasco. You have referred to many important points, including, among others, the need to have an understanding of these products and services, and also to develop the right or appropriate behavior, so to speak, in relation to these novel products and services. But you have also touched on the cross-border nature of crypto trading. And in relation to this point, I want to ask Richard Fox about And this means that users have their pickup of platforms to trade on after deciding on the type of token they wish to buy. In relation to this, what are the key considerations or risks users need to bear in mind when selecting platforms, in particular, given this cross-border nature of the crypto trading? What are also the potential cross-border implications of this market? Over to you, Richard, please.
Thanks, Josephat, and like my colleagues, I'm delighted to be joining you here today on a topic that is really key for regulators at the moment, but also for many investors, and I know for the crypto industry itself. I think the first thing I want to stress, I won't repeat it, but I think the importance of the questions that Tuan Le and Vasco have flagged and the steps you need to take. So before you have got to the point where you are sure you want to invest, you know what type of digital asset you want to buy, and you have got to the stage where you're deciding on what platform, I really would pause though. The steps that Tuan Le and Vasco have suggested people take are really important. So it's worth asking yourself, if you're getting to the point of choosing a platform, how did I get here? So was that via social media? Was it an influencer? Did the approach, was it a cold approach? Were you looking to invest, or did you receive an email or a message on your social media that you weren't expecting? Those are slight alarm bells. So we've talked a lot about social media influencers, but I think it's such an important aspect of this market. If, for example, a sports star is telling you to invest in crypto, well, it's worth asking yourself, they probably know a lot about sport, but what do they know about digital assets? So it's always worth pausing for thought. Okay, I'm at a platform, or I'm thinking about using a platform. What was the journey that got me here? And are there any red flags on that journey? But let's assume you are comfortable with those steps. And I should say, and I think my colleagues would agree, there's nothing inherently wrong with risk. We are not saying investors should never take risk. Risk is a part of investing, but it is about taking careful and conscious risks. You should be thinking through the risks you take before you take them. So you have done all of that good work and you know you want to invest. Well, I think a couple of things then become key, which for me are the next level down of detail. So because this market is inherently cross-border, and what do we mean by that? Well, these companies live on the internet. So they are available 24/7, 365 days a year. So it's important to know, well, legally, where does the company you're dealing with live? So where is the company incorporated? Where is its base of operations? Because legally that really matters. You should be checking things like, is it registered in the jurisdiction where it is based? Does it need to be registered in the jurisdiction where it's based? And those are quite important indicators. So to use the UK as an example, companies that want to do crypto business and want to be setting themselves up in the UK, well, they have to register with the Financial Conduct Authority for their money laundering controls. As Tuan Le mentioned, there is a public list of who has registered. And indeed, we run a list of people who we think might be trading and haven't registered. And to use the UK just as an example, there are only 38 registered companies. And our list of people we're suspicious about has several hundred on it. We're not the only jurisdiction to do this. Australia has registration. So check, do they need to be registered? And if they do, are they? And if they're in a jurisdiction where there are no requirements to register, you might want to think about why. Okay, so you're with a registered platform in the country, you're comfortable with that, but what do you do if things go wrong? Who do you complain to and how? Because in many, many jurisdictions, you simply don't have the normal recourse to complaints or redress that you might have in a regulated market. So in the UK, you cannot complain to our ombudsman about this. So again, that's not to say there is nothing. Many companies have ways to complain, but you should understand them in case something goes wrong. And if you're comfortable with that, some actually more basic things are still relevant in this market. If you were dealing in a traditional security on a traditional market, you would care a lot about the fees and the charges that that platform charged you. No reason that crypto is different. What are the costs? How are they paid? Because generally transaction costs are quite high in this market. So you should be really careful that even if you are doing well and you're making money, how much of that is being eaten into by fees and charges? And then the final point I'll make is everything I've talked about so far in my answer assumes that there is a centralized platform that you are dealing with, right? You know at least who you're doing business with. In the DeFi world, in the decentralized space, everything is more complicated. Because particularly the point is that there is not one person sitting in the middle that you are dealing with helping to oversee things. Now, there's a whole load of detail about how generally decentralized things are. But to put it simply, that person, there's a claim that they don't exist in DeFi. You're just dealing with protocols on the blockchain. And I think you just need to be a lot more confident that you understand that, because it is a whole lot more complicated than dealing with a centralized digital asset platform, of which there are many high-profile ones that people on the line will know. So there's a fact, quite a lot of work to do, I think, before being confident that you can invest in this market.
Yes, indeed. And thank you very much for your comments, because I think you have also reminded us that we need to go to the basics and ask the basic questions, as you were mentioning, whether the entity or the platform is registered, what are the redress or complaints mechanisms available, and who is really behind on these transactions over the internet. So we need to recall historical events, and quite often history is the best teacher. For example, while 2021 was the year when crypto surged, 2022 was when a lot of the underlying risks and misconduct in the market made its presence known, and in a big way. So I would like to ask Vasco whether you can share with us some key learning points for investors from the Terra Luna episode. What are the lessons we can learn from that experience?
First of all, this was really a terrible case that unfortunately erased tens of billions of dollars of value in a matter of days for investors, retail investors, and sometimes affecting life savings of many people, including seniors. It was a billionaire collapse of a platform that had a huge impact on digital asset markets, and I think it sent shock waves across the globe, affecting different regulators in different ways, even in Brazil. So it was also an opportunity for learning, as any crisis poses an opportunity to think about what went wrong, what we could do better next time. And also an important case for us, I remember one of the meetings of the steering group discussing how we could coordinate our response, and it was very useful. And I think it clearly proves the value of IOSCO, of this committee, and the task force that is led by Mr. Tuang Li. So I think that it's important initially to comment that the case involved algorithm stablecoins. So to maintain their value, those algorithm stablecoins are backed by a set of smart contracts on the blockchain, also referred as a protocol that requires collateral in the form of other digital assets to be put into the system in order to issue the algorithm stablecoin. So this is a particular type of stablecoin. It's not a reserve-backed stablecoin that relies on a third-party organization for example, to manage monetary supply and maintain adequate reserves in terms of other bonds or cash equivalents. Such stablecoins rely on softwares to control the supply and maintain adequate collateral. So it's a new area, it's a new market in a developing stage. And this is something that we need to learn how to deal with in the coming years. But I think there are some, with the benefit of the insight, there are some lessons that can be learned. First, as I mentioned, many investors risk their life savings. The fact that major economies were experiencing low inflation and interest rates are low by their time had encouraged many retail investors to look for more attractive investments. And as the value of those investments were rapidly increasing and providing large returns, many investors even took additional risks and borrowed money to invest more money than initially conceived or were possible. And those are hit harder by default. I think losing their savings is something very bad, but it's even worse if you're still having some loans to pay. So of course, it's easier to say after the events, and I'm not trying to blame the victim, but I think that investors really should be aware of those campaigns to promote these investments, alternative investments. Also, we know that there were some individuals that are publicly claiming and even campaigning against those platforms, saying there was an imminent doom approaching. But some investors that were skeptical in the beginning, but perhaps by psychological factors, the fact that they are continuing earning high yields on their investments perhaps played a role on perhaps not taking into account those signs of fraud. One of the key messages here is also that this case poses an opportunity to reflect on the tendency to invest in sometimes based solely on news, on celebrity endorsements and testimonials of millionaires and even market participants that perhaps were profiting from these investments. And they may lend their credibility to and perhaps unconsciously to lose a doomed project. So I think the basic recommendations that we're discussing here today for investors are still applicable here, and there are lessons that perhaps the facts that have confirmed their importance.
Thank you very much, Vasco. Actually, you have referred to be careful with these high yields that might be offered to attract more investors. But Richard also mentioned what to do when things go wrong. And I think we need to look also at any lessons learned from the recent bankruptcies. The Terra Luna started a chain effect that swept through the crypto ecosystem. And we saw a number of high-profile bankruptcies, particularly firms that provided crypto lending services, often at high yields, such as Seychelles Network and Voyager Digital. So, Richard, I wonder whether you can share with us some learning points that you think investors could derive from these bankruptcies. Over to you.
Certainly, and Josephat, you used a nice phrase a moment ago that I want to go back to. You said the reminder to go back to basics, and that's what I think are some of the key lessons from the recent collapses. Now, I should say, I want to echo Vasco's point that whilst it is easy to talk about technical lessons from this episode, for all of the regulators I have spoken to, front of our mind is that this was real people's lives, real money, and real harm. So this isn't sort of a technical exercise for regulators. This is core to our remit of protecting people from losing life-changing amounts of money. And I don't want anyone onto the call to doubt our seriousness with which we take this. And again, it is not about blaming investors, but I do think that some of the lessons that come for this are about going back to the basics that would apply everywhere. So there is nothing special about the technology of digital assets that has somehow changed the basics of risk and reward. So whilst the interest rate environment around the world is currently changing, we have had a period where rates have been very, very low, if not close to zero. So if something is offering you 10%, 15%, 20%, you should pause. How is it doing that? How in a world of nearly zero rates can a company confidently suggest to you or even promise you that they will make you 20%? That big gap tells you it's either a scam or a fraud, or even if it's legitimate, it's having to take an awful lot of risk to deliver that much return. So those should be some of the basic alarm bells that ring in your head. Whenever something sounds great, does it sound so good that it's too good to be true? And then think about what they are doing. So you asked me specifically about lending products. Well, there is a reason that generally around the world, lending is quite highly regulated. So where banks are providing loans, there is a huge architecture of capital, liquidity, conduct. And even where non-banks are doing it, most jurisdictions regulate that activity quite a lot. And there's a reason for that. The risk and return involved, the assets they need to hold, the amount of cash they need to survive shocks. All of those things mean that around the world, most countries have stepped in to regulate that. Now, that's not the case in lots of places here. So crypto lending. So they're doing something that normally should be regulated and it's not. Again, doesn't mean you shouldn't ever do it, but it means that those are red flags that should really give you pause. And colleagues have talked about this already. Stablecoins here are a really good example, because the next thing I want to flag is complexity. So in the normal traditional world, if an investment was really complicated, it would probably give you pause for thought. Well, I think you should pause for thought here, because digital assets are complicated. And then different forms of digital assets are even more complicated. So we've already said at a very high level, there are lots of different types of stablecoin. And the different types talk to, well, how stable are your stablecoins? So is there actual money or assets locked up somewhere to protect it? Or is it computer code that is keeping it stable? And also, so lots of jurisdictions, and the UK is one of them, we are bringing forward new legislation. And that legislation is all about making sure that the promise of stability can be relied upon. And unless and until jurisdictions regulate, you should be really careful before just trusting the claims of stability in stablecoins. And that's just one example of this being a really complicated market. So, Josephat, is it too good to be true? And how complicated is it? And the better it sounds and the more complicated it is, the more I would urge investors to slow down and pause for thought.
Thank you very much, Richard. And you have referred to some of the things you are doing in the UK to address these risks. But I want to ask Tuan Lee whether you can share with us what else you are doing in Singapore, and also this is a question for Richard and Vasco, to alert and educate consumers, and whether you see whether there are some certain segments that tend to be more exposed to these risks. For instance, young investors, senior investors, other segments. Over to you, Tuan Lee, please.
Thank you, Josephat. So on MSS front, we have been very consistent with our message to the retail public. that insofar as where cryptocurrencies are concerned, we have been warning people about the risks of investing in cryptocurrencies. So just to echo Rich, when he said it is too good to be true, it usually is. That's our message to consumers, that actually when it's not just in cryptocurrencies, in all scams, when the returns look too good to be true, they usually are. So there's no free lunch here. So that's why we have been telling retail investors to be very careful, especially when investing in cryptocurrencies. So earlier in this year, in January, we took further steps to restrict, to put further restrictions on advertising of cryptocurrency. So no TV ads, no ads on the public transport system, and no ads on social media platforms. So we even also placed restrictions on what we call crypto ATMs. So previously there were crypto ATMs in public transport systems, so we have also asked for those to be removed. So this has been a consistent message to ask people to be careful, so that people are not being allowed or being hyped into investing in these assets. So that people are able to analyze, find out, do their research, and not be emotionally pulled to invest. So we have a national education campaign that we have consistently also reminded people the risks of putting their monies in cryptocurrencies, and some of the scams that have been perpetrated by some of these platforms. So, of course, being a very digital type of investment, we see that young people are generally quite attracted to investing. And plus, of course, the volatility also means that you can make quick returns. Of course, you can also make quick losses. But of course, when the assets were going up in 2021, asset prices were going up, a lot of people jumped onto the bandwagon. So we have been we have been trying to send the message to the younger crowd to using, actually, we talked about influencers. We also try to use our own influencers to reach out to the younger crowd. So we use platforms like TikTok, like a bit more of the infotainment type of method to reach out to the younger crowd, to some kind of more attractive way, I suppose. So especially when the Terra Luna collapsed, we took the opportunity to send out some messages also. So the use of creative ways to reach out to the younger crowd, social media platform. We also try to reach out to the younger crowd by using comic strips. So content in the form of comics where the content editor is able to share his or her own personal experience when with the rise and the plunge of the crypto assets values. So this is a way of kind of trying to reach out to the younger public through different platforms and media to send the message. So we've been trying to be quite creative here in using different platforms. So, but of course, the message has been that also that consumers also need to take personal responsibility. There's just so much the regulator can do. So please look before you leap, do your research, and do your due diligence. Don't just believe anything that people tell you or your friends tell you. Oh, look, I invested in this, I made X amount of returns. So just be very careful, do your own research, and we'll all be better off by doing a little bit of homework. Thanks.
Thank you very much, Tuan Le, for sharing this experience, because I think a lot of jurisdictions are also looking at Singapore and other jurisdictions that are doing many things to protect investors. I wonder, Vasco, whether you want to share very quickly with us your experience on measures that you are taking in Brazil in this regard as well.
Yes, thank you. And just to give some background information of Brazil, which is a country with a low number of investors traditionally, but this started to change 6 years ago, with the number of retail investors jumping from in stock exchange jumping from 500,000 to more than 5 million retail investors. A new generation of Brazilians that are investing in capital markets for the first time in their lives. It's good news, but we have a huge responsibility with this new generation because they are investing and sometimes they do not have the skills or not aware of the risks. And they are also fast adopters of the crypto world. A recent study pointed out that Brazil is the 7th economy in adoption of crypto assets, and the number of Brazilians purchasing crypto increased 68% from June to July 2022. So just 1 month, the number of investors trading crypto assets in Brazil jumped 68%. And BIMA, a separate organization, a report that we have probably more than 4 million people invest in crypto assets in June. So, and another trend that it's good, but may complicate things a little bit for us to educate is a trend that some new banks are moving into crypto world. And as the largest local digital bank in Brazil, a huge platform that is among the 4 largest banks in Brazil, reached around 1 million crypto users after launching its platform in May. And so that trend can make crypto even more popular and our work more challenging. But it's good news as I was mentioned. So in terms of education, I think IOSCO community is a huge knowledge platform. We learn a lot with FCA, with MAS, Singapore. They have excellent materials, and it's also US SEC and CFTC and other markets, because for developed growth markets and developed markets, some types of assets and strategies actually start to gain traction first in more developed markets, and then we have also these, reaching other countries. So we have this opportunity, and so we do a lot of work that is based on what the others do, on initiatives, on education, on social media. But I was just to mention that we need to be on where investors are. So as the new generation in Brazil is moving to TikTok, we launched a channel on TikTok. We have Twitter, Facebook, YouTube, LinkedIn, WhatsApp, Instagram, and now a TikTok profile. And we talk about crypto and fraud and try to do this in a funny way. And I think but my team is getting better on that. We also partnered with industry to launch social media campaigns, and there are 3 initiatives that I want to mention. We launched a portal called MVCF Investment, which is the CVM title, backwards, fake plus fake, which was a platform that was offering investment opportunities for investors, all fake news, of course. It's interesting that this website created by a partnership between CVM and BIMA, offering investment opportunities that are too good to be true, actually in just 4 months had almost 20,000 hits, and around 20% of the users tried to invest, and they got a message from us. So this is fake. So the upside it's a conversion rate higher, and it beats the traditional 3 to 5% of email marketing approaches. So it's very powerful. So it's good, but not for the reasons the fraudsters trying to offer such schemes of opportunities of investment. And the page has been updated and will be launched by the end of the year, a new version. We also launched a pilot of training teenagers on blockchain in a favela in Rio de Janeiro. Was a pilot project with World Bank. We combine financial education and digital literacy, and we're doing the same for teachers. Last year, we launched a platform for training 500,000 teachers, school teachers in Brazil, in partnership with the Ministry of Education. We also have a strategy of local centers. 7 local centers for financial education have been launched so far to provide in-person opportunities for training. But the next, by November this year, all the 14 courses will be available online. And the next step will be, we will be offering in partnership with AB Crypto, an association of crypto economy in Brazil, education for digital economy and crypto assets for those teachers. So we think we might have a huge impact on schools and in the next generation, so they get used with these competencies they must have to make investments in an economy of the 21st century. So sorry about the long response, but these are the main initiatives.
Thank you very much, Vasco, for sharing that with us. Before moving to the next question, I just wanted to touch base very quickly with Richard. You have mentioned some of the measures you are taking in the UK, but I wonder whether you have observed a particular segment being more vulnerable to this type of risks, or is it similar to what is observed in other jurisdictions?
Thank you, Josephat. So the one thing I should say is we have not had the explosion of uptake in the UK that Vasco has just described. So one caveat is there are fewer people in the UK actively trading digital currency, so a slightly smaller sample size. But we have learned some quite interesting things. So our consumer research, and this is published on our website for anyone who wants to follow up, found that initially the people who were actively investing in these assets tended to be over 35, they tended to be male, and they tended to be from a sort of higher socioeconomic group. So what I mean by that is relatively affluent individuals. So initially, we were quite reassured by that in the UK because we thought it more likely that those kind of consumers would be able to afford the losses if they made them. But not only is participation in this market growing, the demographics are changing. So I think, like colleagues around the world, we are seeing increasingly younger investors invest. We are seeing more and more people investing for the first time. There is much more gender balance now. There are just as many women as men investing in this. Indeed, in our recent survey, there were more women in this cohort of newer investors. And also, the investors were much more diverse, so from much greater difference of ethnic background and things like that. So we are seeing more and different people investing in this market. And those people, I don't want to make general stereotypes, but our demographic data in the UK is showing that more people who are less financially resilient are entering this market. So this is not, let me now exaggerate for effect, this is not rich people kind of dabbling with a bit of money for fun. This is younger people investing the little money that they have because they are trying to generate the kind of returns that are being promised by these platforms. And that means when they lose the money, look, no one likes to lose money. But when these people lose the money, this is money they cannot afford to lose. And to mention, and Vasco and Chuang Li have said this as well, particularly if they have borrowed that, either by a credit card or more extremely taking out almost payday loans in order to invest in credit, that is an incredibly risky and dangerous set of circumstances. So whilst initially in the UK, we were reasonably relaxed, we are no longer relaxed about the risks to the investors in this market.
Thank you very much. I think the points you have also mentioned are very useful. For sure, to do more research to understand and to know the profile of the investors. Having reflected on several common risks and challenges across jurisdictions, the natural question for Tuan Le will be, what is IOSCO doing in this regard? What is the purpose of the FinTech task force, and in particular, how the task force is planning to do to enhance protection in this market? Please, over to you, Tuan Le.
Thank you, Josephat. I know that this webinar is targeted at investors, so I will try not to go too much into regulator speak. So what I'll say is this, that the FinTech Task Force has been tasked with developing, overseeing, delivering and implementing IOSCO's regulatory agenda with respect to FinTech and crypto assets. And this includes coordinating with the Financial Stability Board and other standard-setting bodies. So IOSCO looks at this area through the core objectives of investor protection and market integrity through policy lens. This means that we will take a close look at the risks of both crypto and DeFi activities and consider how IOSCO principles, existing principles, may apply insofar as the risks are concerned, and where there are idiosyncratic risks or areas brought about by crypto assets, we will then address them as well. So in specific terms, so there are some risks we talked about earlier, such as market manipulation, conflicts of interest, custody risk, and safekeeping as well. So through the use of IOSCO principles and the adherence of jurisdictions to these principles, we hope that the market will be made safer for investors. So we are targeting to complete our review before the end of 2023. But along the way, we'll give updates of our progress. So our key two, again, just to reiterate that two areas that are investor protection and market integrity. So we will be providing an update very soon, this November, at the Singapore FinTech Festival held from 2nd to 4th of November. So we'll give an update on where we are. So hope you can keep a lookout. Thanks.
Thank you very much. I really want to thank our panelists for taking the time to share their knowledge with us, and also to present this complex topic in simple language, so this is more understandable for all the attendees. I also want to thank again all the attendees for taking the time to participate in this webinar. And before we close the webinar, I want to thank again the IOSCO Asia Pacific Hub in Malaysia for hosting this global webinar. And in particular, I want to thank Shobana and Lina, who provided a really valuable assistance in the organization of this webinar. I think Shobana wants to let us know about a survey that they will conduct after this webinar. So over to you, Shobana, please.
Thank you, Josephat. On behalf of the IOSCO Asia Pacific Hub, we would also like to thank the panelists today for sharing your insights on this very important topic. And we hope participants gain valuable knowledge that will be useful in your respective markets. We would also like to thank the audience for your participation, and it is really encouraging to see huge numbers registered for this session, spanning over 84 countries worldwide. And the recording of today's webinar will also be available on the Hub's website in due course. There will be a very short questionnaire that will pop up on your screen shortly at the end of the session, and we would kindly appreciate if you could take a minute to fill in the questionnaire, as your feedback is definitely important to us. We also hope to see you again in our future programs, and we hope you can join our next webinar on digitalization and the evolving retail investment landscape, happening on the 27th of October as part of the World Investor Week. Over to you, Josephat.
Thank you very much. I think I just want to wish you all a wonderful World Investor Week campaign in all your jurisdictions, and thank you very much again for all the participants in this webinar. Thank you very much.